rings the opening bell at the New York Stock Exchange. It's sort of a new trading day, and we are seeing a rally right out of the gate, as indicated by futures. Continuing the volatility, it's on the upside today, but certainly this has been a week where we have seen big moves in U.S. equities. Let's get a view of what to expect. Alan Nuckman joins me now. He's chief market strategist at Agora Financial. He joins me from the CME in Chicago. So, Alan, I was actually out last week on a break, but I was watching from afar, and we had U.S. stocks all over the place. What are you expecting this weekend? Who is driving this market? Is it short-term, trade-driven? What are the longer-term investors doing?
Well, I try and get people to focus on the bigger picture. Now, with the exception of Monday's open and Friday's last 2 hours, I liked what I saw last week. We had a series of higher lows in the stock market, and we had the markets test those February extreme lows and reject those. It came rallying back in a big way. So I'm looking forward to Friday, as we all do, TGIF, because Friday's when the banks announce. And now we can finally focus on fundamentals and get some of this volatility out of the equation. But it's really, we're seeing volatility decrease, even though we're seeing a 1% move almost every day for the last 2 weeks in the markets. We're actually seeing numerically volatility decrease over the last couple of weeks, and we have not made some new relative highs there in a long time with that March top holding in place. So things are getting a little bit more stable if you can look at the VIX as a measurement.
Yeah, and sort of put aside maybe some of those headline numbers. Can earnings provide the reset that the markets have been looking for? Is it going to be a positive earnings season? Where are expectations?
Well, the expectations are fantastic right now. We're looking for about a 17% earnings growth, and what we've seen is typically, as we come into each earnings seasons, the expectations shrink. We're seeing them expand right now. We've seen a 5% increase in our earnings growth expectations since the new year started. So we're expecting some good, solid numbers. It'll be a reminder of how well corporate America is doing, and we'll see the banks come out with these huge profit numbers. The banks are not hurting, and I think people need to be reminded of how well corporate America is doing. Also, let's remember that this spring quarter, $400 billion in dividends are going to be issued. Where is that money going to go? Typically, it goes right back in the stock market, so we could see that provide a boost as well.
Yeah, fantastic point. We sort of forgot about all of the issues related to that big windfall coming from corporate taxes. Alan, can the market advance without technology? Is the tech sector and some of those high flyers going to be able to shake off some of the individual issues that have been dogging them, whether we're looking at Facebook, whether we're looking about Amazon, or is that going to be a weight around the overall market?
Well, you know me, I like to look at things optimistically. So let's review what happened. We had the NDX, the Tech Top 100, the big boys, the Facebook, the Google, the Apple. They went up 10% to start the year. They declined 10%. They rallied 10% in 2 weeks, and then they declined 10%. Overall, we're net nada, zero, nothing's happened. So yes, it's been quite a ride and there's been opportunities, but you think about the perspective of what it could have happened, the news that we've had, not just in tech, but in all different aspects of the market, and the market's held up very well. Yes, we've given back gains, but essentially we're unchanged in 2018. So I look at that as a positive, not what the market did, but what it didn't do. So I'm feeling very optimistic that we could bounce out of here and make another run to the upside.
All right, awesome, Alan. We always appreciate you helping us look at things from a different perspective. Thank you so much. Alan Nuckman for us.
Thank you.